Hello, hello. Welcome today, friends. How are you feeling today? Oh boy, we have got great stuff to talk about today. We are going to chat about, let's see here. We are going to chat about selling cash secured puts in a high volatility environment. Sort of interesting topic, I would say. Yeah. Now, before we get started, I need to point out options are not for everyone. You should read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at the OCC.com. Don't trade with money you're not prepared to lose. And everything that I'm talking about here today is generalized information, not specific to your personal situation, obviously. So, for those of you who are not familiar with me, allow me to introduce myself. My name is Dan Passarelli. I'm an author of option trading books. The one I'm most known for is Trading Option Greeks. And I'm working on one on this exact subject that we're talking about here today. Do you believe it? Yeah. But that won't be out for like another year. I am also a trader. Been there, done that, still doing it. Traded for years on the floor of the Chicago Board Options Exchange as a market maker, standing in the pits, yelling and screaming, slinging big size around. And now I trade in a retail account just like you. I am the founder of Market Taker Mentoring, which is the global leader in option trader education. We have students in over 50 countries, which is quite an honor. And I collaborate with a lot of people here in the option trading industry, including and especially the good players, the option friendly brokers like Firstrade, who does a great job in doing all things option related for you, like providing this complimentary online training, which is really great, I think, right? I work with a lot of the exchanges around the world, multiple continents. And I'm a family man, married to my wife, Kathleen, who runs operations here. Many of you who are market taker students know her. And I have my two adult children, and all of us love to do lots of fun things. I'm a runner, run a few marathons, as did my wife. My daughter is a runner. Uh, we're all foodies, big food nerds, travelers. We love to travel. I've traveled a lot with Market Taker as well, all around the world. And I'm a music person. We're a music family. So that's me. Enough about me. Let's talk about you. In fact, let's talk about the first thing that I want to give to you before we even get deep into what we're going to talk about today. My podcast. If you are not listening to my podcast, my goodness, you're missing out. I mean, I spend hours and hours and hours a week working hard on it to bring you great stuff. And it's free. And there's no ads. Nothing. Like you could just go into let's see here. Uh hold on. I'll tell you where to go in a second. The podcast is all on mastering covered calls and cash secured puts. Great for wheel investors of all experience levels. Adjustments, mindsets, strike selection, analysis, and more. And there's new episodes weekly. In fact, the first one just, or not the first one, the most recent one just came out today. And hit the questions box. Is that the options writer in Barron's? and Dow Jones, and he's run some advisory firms. He's one of the smartest people in this industry. And today's episode that just dropped today, I'm interviewing him and we're bouncing around ideas. Oh my gosh, I think it's the best episode we've done yet. So check it out. Like I said, it's free. You can listen on Apple, Spotify. Just go to markettaker.com/applepod, markettaker.com/Spotify pod, or honestly, whatever podcast platform you listen in on, that's where you go, friends. Okay. We're on all of them. All of them. All right. Let's jump into what we're going to talk about here today. Cash secured puts. Who knows what a cash secured put is? Hit that questions box. Give me a yes or a no. Yes, no, maybe so. Who knows what a cash secured put is? Mike does. Just Mike? Mike's the only person here in the class? That's not true. There's a whole bunch of people here. This is our most well-attended class yet. Holy cow, we got a lot of people. That is great. Oh, because you are going to get some great stuff here. Hey, it's Mark. Mark, I know you. You're one of our Market Taker family members here. Nice to see you here, though. Right? Unless I'm thinking of somebody with the exact same name. Okay, so we got a number of people who do, and some people who I assume don't, which is why they didn't say anything, and some people who are just not being friendly today. I don't know what that's all about. So, for those of you who are not sure what a cash secured put is, here's the crash course. It's when an investor, and I'm making a distinction, not a trader. Hey, it's Larry. Not a trader, but an investor, sells short a put. And, you know, if you sell a put, the person that you sold it to, the person who's long it, might exercise it and sell the stock to you, right? You might get assigned and have to buy the stock. So just in case you're not caught off guard, you hold cash to pay for the stock in case you do get assigned. So like I said, this is for investors. This is not like get rich quick. This is not like, oh, I'm going to, you know, try and sneak a little money out of the market. This is like a very, very thoughtful process. It can be done risky, especially if not done well, but it can also be really, really conservative. The way I do it is very, very conservative. And you might not realize this, but high volatility environments like we're in right now are freaking spectacular for cash secured puts, which might sound a little crazy because a lot of people think of them as being risky. But I assure you, and I will make the case throughout this workshop here today, that they're conservative. They can be very conservative in this environment, and it is a wonderful environment for them. So let's talk about the data. First of all, there's been a bunch of white papers written. For those of you who don't know what a white paper is, it's like when someone wants to have a third party study something, or if a third party just decides on their own to go and study something, they will write sort of like a quasi academic type paper on it, right? Say, here's the data, unbiased, that we looked at, and this is what the data proves. That is what's called a white paper. And there's been several of them written on this. You can Google them or email me, dan@markettaker.com, or actually just go to my website, markettaker.com, and I'll send you a link to some of these white papers. But they prove that cash secured puts actually outperform just the regular old tried and true buy and hold strategy. They outperform it while lowering risk. It's important. So this is a limited profit potential strategy on any one given cash secured put. We'll talk more about that. And there is potentially substantial risk, just like there is if you buy a stock, right? If I buy a stock can go to zero. Same thing here. The cash that I'm saving to buy the stock, I mean, I could end up buying the stock and it could go to zero, right? So no more risk than buying a stock. The rationale is we're going to generate income or use selling this put to potentially buy a stock at a lower price than the current market price. In high volatility environments, there's a couple of benefits. And they're both rooted in the fact that options get more expensive in high volatility environments. Why? Well, because options are more in demand. Options are risk management tools, right? You can buy puts to create protection. You can buy calls to limit your risk instead of buying a stock. But the thing is that most of the time people get overzealous and too much demand is created. And the options get actually overpriced from a statistician basis. And so there's an edge in selling them. So we can do one of two things. A, we can just sell those overpriced options, or because all of the options on a stock that has overpriced implied volatility, because all the options are higher, instead of selling like the, 100 strike put at $2, we might be able to sell the 95 strike put at $2. We might be able to sell a farther out strike for the same price, which gives us more what we call wiggle room. So let me show you what I'm talking about here. Who's familiar with a P and L diagram, profits and loss diagrams? Give me a yes right here or a no. I want to know. Inquiring minds want to know. Mike is Johnny on the spot today, or Mikey on the spot today. Greg, yes. All right, who else? Come on, what are you guys sleeping today? Come on, hey, look here. Red Bull. It gives you wings, and they're not even paying me for that. It's free advertising. I think some of you need this. There you go. Hey, it's Michael and John, Larry. Of course, Larry's like, come on, Passarelli, of course I do that. You show us that stuff in class all the time. All right, well, the horizontal line is the stock price at expiration. Vertical line is our profit or our loss. So if we put this trade on today and hold it all the way until expiration, what happens? So I sell 180 strike put at $2.75, and I hold $8,000 of cash. Why do I hold $8,000 of cash? Why would I do that? Anybody? Because it's cash secured put. What I'm securing, it's kind of a funny name, right? Cash secured put. What am I securing? I'm securing that I have enough cash to buy the stock if I get assigned. I'm really not securing the put. I'm securing the future potential purchase of the stock. That's what I'm securing. So I hold this all the way until July expiration, which, if assignment happens, good. Thank you, Larry. So holding $8,000 cash, holding this all the way till expiration, which could be, next week, could be 2 months from now, whenever, right? And at expiration, the stock is either going to be above 80 or below 80. Could be right at 80, but what if the stock is above 80 at expiration? What happens? Well, this is what happens. We make $2.75 maximum profit. If we just do nothing and the thing expires, well, then the 80 puts are gone. The cash is still in our account. And so is the $2.75 a share we collected. $2.75 a share, because each put represents 100 shares. That is 275 smackaroos in our pocket. Not really in our pocket, in our brokerage account, right? In our Firstrade account. So, and excuse the coughing here, I'm just getting over a terrible, terrible illness of some sort. I think it was, does anybody live out west, like in the desert area? You ever hear of this thing called valley fever? Were we talking about this on the last episode? You might have talked about this on the last workshop. I think I got valley fever when I was out in Nevada. I went out for a run on a windy desert day in Nevada. And I got back to my hotel and I just sneezed for like 24 hours. And I think the stuff got in my sinuses and my lungs. It was a freaking disaster. What is it? 12 days later, I'm like finally starting to feel human again. So anyway, if the stock is above the strike price, if I sold the 80 strike puts, I sold the right to somebody else to sell the stock to me at 80. If the stock is at like 90, they're not going to sell it to me at 80. They'd be crazy, loco to do that, right? They would just sell it in the market. So, so they would just let the put expire, obviously. They'd rather lose 275. Or if they're smart, they sold it to somebody else before them. So that's where I reach my maximum profit potential. What if the stock is below 80 at expiration? Well, that's when the person who can sell it to me at 80, if it's trading at like 79 or 70 or 60, they would do that. So I'm going to be long shares of this stock at expiration if the stock is below the strike price of 80. Makes sense? This is easy, right? What price do I buy the stock? Who can tell me? For a fabulous prize, the prize of pride, the best, most sinful prize I can offer you. How do I say it? Piotr, I'm sorry. My ancestry is 1/8 Polish, but I don't speak any Polish. Piotr? Is that Polish? I think it's Polish, right? Says 80. And you're first, my friend. Oh, Peter. Yeah, okay. I kind of figured it was Peter. So, okay. Peter is first and wins the prize of pride for being the first to answer. Justin, you're a close second. Second gets you nothing. Nothing. You got to be quick around here if you want to be a trader. But Justin points out something pretty good here. Same thing that John pointed out. Same thing that Mark pointed out. You guys are doing pretty good. So there's kind of two right answers here, right? There's the technically correct answer, which Peter got. And then there's the sort of arguably more right answer that Justin and John and Mark and Big Al, capital A space capital L, Big Al is alluding to, but I think you're off the handle here. Really, if you think about it, I'm effectively buying the stock at $77.25. How the heck did I come up with $77.25? Dan, what's in that Red Bull? Wouldn't you like to know? So yes, I do technically buy the stock at $80 a share, and I've got 8,000 smackaroos to pay for that stock, but actually don't need the full 8,000. You know why? Because, man, I also got 275 smackaroos too, right? I collected the 275 bucks. When I sold the put, I'm going to keep that no matter what. They can't take that away from me. It's mine. So basically, yeah, I pay 80 bucks a share, but I also have $2.75. So what I really do is I subtract the strike price minus the premium received. Let's show a little equation here. Strike price minus the premium received. That is my actual break even. Yeah? Makes sense? All right. Good job, everybody. Okay. So cash secured puts is something that, like, there are who, let's be honest here. Don't you think it's important to be honest? Not with me, but with yourself, right? Don't you think it's important to be honest? Be honest. Who here thought at the beginning of this presentation, and maybe you still think it, or maybe at some time you thought it, cash secured puts, that's crazy. Those are way too risky. Who thought that? Come on. Come on. Come on. Who thought it? Who thinks it? Thought, think, will think? Anybody? Nobody. Yeah? Okay. Fair enough, Lewis. Fair enough. Could be. Stock could go to zero after a sign. Right. Just like a stock could after you buy it, right? There's risk to everything. So, Lewis, I appreciate your honesty, not with me, but with yourself. And let's talk about this. Just going out and selling a put because, oh, yeah, the stock will surely be above that strike price. That's crazy talk. But when we have a plan for it, it's different. And it's not like a different action. It's like, you click on the bid and you click send the order and it shows up in your account. Like you're doing that either way. But the difference is in the gray matter between the ears. If I have a plan for it, it can be a very pensive, thoughtful choice. If I hold cash because I actually want to get assigned, now this can be a very strategic thing to do. Now you might think, wait, you mean I'd be okay getting assigned? No, not really okay getting assigned. Actually kind of want to get assigned. I do that in my IRA all the time. I don't know. I can remember the last time I actually went and just bought a stock. I can remember that. But I would say easily, I don't know, probably 60% of the time, the way I buy a stock is from selling a cash secured put. Using them for the sole purpose to hopefully get assigned. Why? Well, my motivation is because I can potentially buy a stock at a much lower price than the current market price, and I keep the cash in order to do so. So let's look at an example here. This is a chart of GLD. Now, I've been saying stock. GLD is an ETF, and I can use it for those too. This is from a couple days ago, I guess. So GLD, I look at it and I'm like, holy cow, it's making new highs, blah, 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 blah. I'm concerned about the market going down. I'm concerned about inflation. I'm concerned that I see China's central bank and other central banks have been buying gold for many consecutive months. I think that gold could continue higher, and it's just hypothetical, okay? Price is not current, for example purposes only, and I'm not saying that for like legal reasons. I'm saying that because It's true. They're like, I'm not trying to give you a trade idea. I'm just giving you an example. I think that gold could continue higher, but hey, we're like near all-time highs. I kind of don't want to buy it here at the current price. Instead, what I would like to do is buy it maybe if it goes down a little bit. What if when gold is at, and this is specifically the GLD ETF, if the GLD ETF is at 307.30, what if I sell the 300 puts? Okay, I can sell them at $2.87. Okay, well, this profit and loss diagram, P&L diagram, is a good friend. One of two things happen. If GLD is above 300 at expiration, May 9th in this example, then nothing happens. Put expires and I get to keep $287. If it goes below 300 and it's below it at expiration, then, well, I still get to keep $287, but I buy shares of the GLD ETF at 300. But I also have that 287, so it's really like buying it at $297.13. So there's a couple of things to unpack here, and let's just get that break-even equation back up there. A couple things to unpack here. One, where did I say gold was? Gold was at like 307 and change, right? If I bought it at 307 and change, well, first of all, I could have risk, right? I'd have about an extra $10 of risk, right? Because I don't lose money until this gets down to 297. It was at 307 when we hypothetically sold these puts. So I've got a full $10 of cushion. It can go down and I can still make money. But it's also like I make $2.87. So it could have gone from 307 and change to like 310 or whatever. And I would still make just as much money. I can add another point to this, which is the point at which where the stock was or the ETF was when I made the trade. So 307 plus 287. So that's like, just call it 310. I'm happy if I made this trade instead of buying the ETF, as long as it's below 310. Right? And I'm happy if I made this trade instead of buying the stock, as long as it's above 297.13. I've got a whole $10 range on this $300 stock. So like a whole 3% range. And this is like, I don't know, John that works with me helped me. He actually put this together for me. I want to say he did this on like end of last week. It's probably like a 7-day trade or something. So there's this 3% range that it can wiggle up or down in, and I outperform buying the shares. And if it goes down to 297 and I buy it, great. Presuming that in my mind, I set that as like a quasi limit order, right? Like I want to buy it at 297.13. A lot of times people say, I'd be okay buying it at the break even, 297.13. And then it's trading 295 and they say, oh my gosh, this is the end of the freaking world. I can't believe I paid 297.13 and it's at 295. I lost money. Why? I lament. Why did I ever do such a terrible thing? I mean, hey man, what if you put in a limit order to buy GLD at 297.13 and it gaps down to 295? Do you say, well, first of all, I guess if it gapped down, you'd get filled at 295. But, if you get filled at 297.13 and it drifts down a couple of bucks, do you say, oh no, this is terrible? No, you just wait it out, right? Especially if it's a stock. I mean, gold has shown that it goes up over time as well. But so, like, this is the big magic of it. Oh, so, so that 10% range or whatever between 297.13 and just call it 310. I mean, that's the magic zone. But it's also kind of the magic zone below here because it's a limit order and we're buying it on a dip, plus, really, right? So we're still happy if we buy it. But if it goes up and it's say like it's trading at 315, then we say, oh no, I'm such an idiot. Stupid, stupid, stupid. Why did I do that? I should have just bought the shares. Well, guess what? You can just sell another put, collect another 250 or $3 or whatever it is. Now you got like, $5 or $6. And if you skate on that one and don't get a sign, you sell another put. Is it going to go up forever? Well, I mean, yeah, it probably is going to go up forever, but it's going to have some dips, right? So, like, this is people don't fully appreciate the magic of cash secured puts. And the real magic is that when markets are volatile, like, I mean, yeah, like, look at this GLD chart here, right? It's gapping all over the joint. That makes the options get more expensive. That means I can sell this put for more. Like in a normal market with the ETF at 307 and change, the 300 puts might be like $1.50 or something. Now, because there's so much volatility, I sell them for so much more. Right? It's such a powerful benefit that is so overlooked. And people look upon it with fear. People look upon this volatility selling puts with fear instead of opportunity. And don't get me wrong, opportunity means opportunity. It doesn't mean guaranteed profit, right? But fully weigh the benefits that come with this opportunity, and I think you'll see some real magic. Blah 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 blah. And it's really only magic if we do this cash secured. We hold that cash, in this case about $30,000, in the account. Otherwise, we can end up over leveraged, getting a margin call, and we don't want to do that. We don't want to be caught off guard. We want to think about this as if, hey, I'm kind of buying the stock here, but I'm buying the stock with a potential extra benefit. Okay. Another example. Again, price is not current. This is from a few days ago. For example purposes only. I'm just trying to show you how this works so that you are empowered, and when you see this on your own, you can capitalize on it. We got some support here at 225. Pretty strong support at 225. I'm not sure where it's trading now. Just like take a look here. Got my Firstrade window open here next door to me. It's trading higher now. But at this time, it was trading at 255 exactly. Very strong support at 225. Okay. So I pull up my option chain, and I think that very strong support, I think, can hold. I think for whatever reason. I don't know. Like I don't have a horse in this race. I don't have a position long or short in Tesla. So, just hypothetically, I think that support's really going to hold for a good, at least 3 weeks, probably forever. Um, there's support at 225. So if I sold the 225 puts, I could get $5.60. That comes out to, let's see, 560 divided by 255. That's about 2.2% in 3 weeks. How many 3-week periods are in a year? Well, 52 divided by 3, 17. If I could make 2.2 cents 17 times in a year, I'd make 38% in a year. So if my objective is that I think it's a very slim chance that Tesla gets down below 225, and if it does, because that's such a strong support level, I would like to own it there. Not I'd be okay owning it there. I would like to own it there. Because the implied volatility is so high, which often happens when a stock goes down a lot, like we saw in Tesla's graph here, Tesla's chart. These options get really expensive. These 3-week options would normally not be 2.2% of the stock price. Just how far, 10% away. They would normally be much less, but because it's down, because it's volatile, they're much more expensive. It's such a strong benefit. So we have this picture. If we stay above 225, hey, I make 2.2%. And, that's not the end game, okay? If your whole goal in life is to one time make 2.2%, you're not aiming very high. But if your goal is to make 38% a year, which annualized is what this comes out to, now you're aiming high. And you can make a case for this being a trade that can potentially help you achieve this. Now, truth be told, whatever that annualized amount comes out to, in this case, 38%, you're never going to make that. Okay. It's always going to be something a little bit less. Why? Well, because this incredible time for selling cash secured puts where the market's volatile and implied volatility side, it's probably not going to last another 12 months. It might. There's a lot of factors, who knows when the tariff thing's going to get resolved. I think everybody in the whole darn world hope it gets resolved pretty soon, but we don't know, right? We don't know. But probably market will cease being as volatile within a year. And even if it doesn't, whether it does or doesn't, that support might not hold forever. Or if it does, like, as of today, Tesla's at, what did I say it was, 273 or something? 270, yeah, 273 and change. So I wouldn't be selling the 225 strike. I'd probably have to sell a higher strike to get 2.2%, probably like 245 strike. So, that might get violated. I'm not going to skate and avoid assignment every time. But, that 38% a year is like a good idealist benchmark. Or if I buy it, if 225 is the support and it breaks support, I'm actually buying it $5.60 below support, which is another like 0.2% or something, right? Yeah, 0.25%. So there's a lot of power in this as well. So I was just writing the chapter in my book, my upcoming book, which is not going to be released until next April. I'm only like 25% done with it. Just signed the contract like a month ago. Coming out under Wiley publication, just like my first book. So I was just writing about this. Cash secured puts and covered calls are actually the same thing. Now, not exactly the same thing, but synthetically, they are equivalent. Now, every time I say this in a class, if there's 60 people in this class, I'm going to get 12 people saying, nope, that is not true. You're wrong. You're crazy. What's the matter with you? I hate you. Nah, they would probably say hate you. Maybe one of them says they hate me. I don't know. But, and we just had like 3 people drop out. Those are the people who said, no, you're crazy, Passarelli. You're losing your marbles. That's not true. That can't be true. Cash secured puts are risky. Covered calls are they're very conservative. Well, like I said, it's a matter of perspective. If I'm holding cash in the account, like what do you get after expiration? If I have a cash secured put and the stock is below the strike price, after expiration, I own the shares. With a covered call, if the stock is below the call strike price, after expiration, I own the shares. If the stock is above the strike price on the cash secured put expires, I own nothing. Covered call, if the stock is above the strike price at expiration, call gets signed, stock gets called away, I got no position. You have the same thing after expiration with either of them. Logically, that means one can't be a better trade than the other one. If it was, there would be an arbitrage opportunity. And the really smart traders would make gazillions of dollars. Right? Like, think about that. If there are 2 different trades that yield the exact same results, and one you can sell for a lot, one is trading for a lot and one is trading for a little, smart people will sell the one that's trading for a lot and buy the one that's trading for a little, and they offset each other, and there's basically no position, right? And they lock in an instantaneous riskless profit. These are called synthetics. Now, the reason why this is hard for some people to wrap their head around is because what we're used to doing is trading only the out of the money version of either of these. Selling a lower strike put and a higher strike call than where the stock is. So this is only actually valid when we're talking about the same strike. So the best way to think about it is selling an in the money cash secured put would be the same as an out of the money covered call. Or an out of the money cash secured put would be the same as selling an in the money covered call. Or at the money, whatever. All right. So because we tend to trade cash secured puts differently using that lower strike, we have a different mindset for it. It's not where would I be okay selling this stock? It's where do I want to buy this stock? We look for support from a technical standpoint. From a volatility standpoint, we want the option to be expensive. We want overpriced implied volatility. Now, we did, I keep my Firstrade schedule over here. We did a workshop on volatility analysis. Go to Firstrade's YouTube channel and look for that. Yeah, we don't have another one coming up on volatility, but it's already been recorded. Just go look at it. Fundamentally, there's a couple of things we can talk. I just wrote a whole chapter on cash cured puts, and half of it was on the fundamentals of it. The biggest thing is avoid earnings, right? For those of you who are listening to this live right now, the 60 or so of you who are, Palantir just had earnings. If I had a cash cured put on in Palantir, like that stock was down quite a bit earlier today anyway. I don't know where it is now. Would have got pretty, I would have bought the stock at the strike price at the break even, but, would have gapped a lot lower, which is not the end of the world. I could just roll that into a covered call. It's called the wheel strategy, which I think we're going to be talking about again soon. I've talked about it already on Firstrade. So I always want to avoid earnings or other expected volatility events. But, like for those of you who are good at reading like financial statements, like your CPA or something, or you've just studied it, you've read books like this one here, The Intelligent Investor by Benjamin Graham. I recommend this one if you want to learn how to analyze stocks and bonds and stuff. You can put that fundamental analysis to very good use as well. You got to have a lot of knowledge with that. But, you look at things like P ratio, book value, tangible book value, cash flow, operating margin, etc. It can help you make great decisions with cash cured puts. But that's, oh my gosh, that's a whole webinar series. So if a stock is trending lower, I might let assignment occur. If the stock moves violently lower, unexpectedly, I mean, like, if earnings is coming out, we're not going to have the trade on anyway, so that's not a problem. But like, if just some unexpected news comes out and moves violently lower, that is going to happen time to time. So we might decide to close the trade, just buy the put back. I mean, unless we want to get assigned, because we're thinking about this not on, oh, well, I want to sell this stock next week. Like, if a stock I own is down 10% and I have to sell it next week, well, I'm in trouble. But if I'm holding it for a long-term investment and I'll probably sell it 5 years from now, I don't care if it's down 10% right now. It doesn't matter. Right? So the buy and hold strategy. This is a tried and true thing. Selling cash cured puts, or covered calls for that matter, is just a way to make the buy and hold strategy better. We might use selling cash cured puts to set a target price to get into the stock. And sometimes the buy and hold strategy will use it for a stop loss. Some investors will do that. Me, I take a very long-term view on investing, so I tend to ride it out. If it's trading, definitely stop loss. And sometimes if, I let my stock or let my put get assigned and the stock goes up, 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 I might set a stop loss for profit taking for sure. Or just sell like an at the money or in the money covered call. Okay. So selling puts. Like all option strategies, they have a specific purpose, and there are some times that they're more beneficial to do than other times. When implied volatility is very, very, very low, It's hard to find good cash cured put trades. When it's high, you can find way better ones. Now, they say when implied volatility is high, it's high for a reason. And there's some truth to that, but usually implied volatility is overpriced, especially when the market's volatile. Humans are making the buying and selling decisions that create demand and supply. And humans are emotional. And when there's a lot of volatility, fear takes over. People buy options at higher prices than they should. And that's okay for us. It's bad for them. They're making a big mistake. For us, we're glad to sell it to them when it's overpriced. Right? Just like, go look up the stock price of Humana or Aetna or Prudential. Look at their earnings. I haven't looked at their earnings in a while, but they're still in business. So they must be making money. How do they make money? Well, they figure out how much all the people they're insured, how many people are going to crash their car and how much they're going to have to pay out. Divide that by the number of people, factoring in, if you're a 18-year-old male with a red sports car, your premiums are going to be higher. And they sell insurance for a little more than what statistically it's worth. And they make hundreds of millions of dollars doing that. Well, this is what put sellers do. This is what cash cured put sellers do. We look for opportunities when we can sell puts, insurance, when they're overpriced. Right? We don't just indiscriminately sell them, not think about the implied volatility. We have to think about the implied volatility. And if we do and sell them when they're overpriced, which is most of the time, we've got a business just like Prudential or Aetna or Humana does. So we select the strategy that fits the market. For me, I love selling puts when the market is down. Why? Because that's when the fear really kicks in. That's when the puts really get more expensive. And sometimes I'll sell right at the money to make it more likely I get assigned. Sometimes I'll say, okay, well, this stock is here. It went down to here. Options got really expensive. If it gets down to here, I'll buy it. And sometimes I do. There's some stocks that I did that with. In fact, I did that with spiders. I bought them, like spiders were here at all-time highs, and then the market was heading down, down, down. I sold puts, skated, gets to keep it, sold more puts, skated, gets to keep the premium, sold more puts, skated, got to keep the premium, sold more puts, got assigned. Sold more puts at a lower strike. And then spiders were down below my strikes. I owned them here. Spiders were here. Did I say, oh no, this is a terrible strategy? Nope. I said, whoo, I did something smart. Right? Telling people at the time you did something smart, there's a lot of naysayers who are going to say, how can you say you did something smart? You bought the stock at the strike price and it's below the strike price. Dan, you made a terrible mistake. No. Figured it's going to go back up. And it might go back down below the strike price where I'm assigned. It's above it now. It might go back down below the strike price where I got assigned. And if it does, that's okay. I'm not in this for a week or even a month or even a year. I'm in this for the long, 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 long term. And at some point when the market gets way overpriced from a valuation standpoint, I might start selling some at the money covered calls against those shares that I acquired here. And this, friends, this is how you trade the buy and hold strategy, but trade it better. You augment it. Do we have any questions before we call her a day? Any questions before we call her a day here, friends? You guys asked some good questions early. Got some good answers here early. That's it. All good? All right. Have a great rest. Oh, you're welcome, Mike. Have a great rest of your day. And I will see you next week when we talk about smart risk tactics for option traders. That's going to be using specific strategies to um, trade in a lower risk sort of way. Oh, you're going to love it. All right. I'll see you next week, friends. Talk to you. See you, Larry.